FHA versus conventional home loans. And if you're trying to figure out which one is best for you, then this video is for you. Based on data from 2024, 69% of home purchases were conventional financing and FHA was 19%. The additional was a mix between VA and non-QM loans. But that doesn't mean one loan type works for everyone. There are several types of mortgages available, and FHA loans are one of the most popular alternatives. Hi, I'm Alex Ramirez, and I help first-time homebuyers and step-up homebuyers navigate the mortgage process with confidence. And don't forget to like, subscribe, and tap that bell so you don't miss any of my weekly updates in the future. Now let's dive in. By the end of this video, you'll know everything you need to confidently compare FHA and conventional loans and decide which one fits your financial goals. And here's what you'll learn in this video: the key differences between FHA and conventional mortgages and why one isn't automatically better, who each loan fits best with real examples based on credit, income, and down payment, and what you really need to buy a home, like credit score, down payment, and DTI breakdowns, and how mortgage insurance works, cost, duration, and how to remove it, how FHA versus conventional appraisals differ, and what buyers and sellers should know, and how to build a smart loan strategy. Start with FHA or go conventional for long-term savings, and actionable steps to apply what you're learning on your home buying journey. And let's go over some general information for home loans. When you search online for home loan information or interest rates, most of what you'll see is built around conventional home loans. Conventional home loans are the standard. They're the default, and unless you ask specifically for something else, most lenders will automatically quote you interest rates and information on conventional loans. A good lender will ask you more questions, and that can cause some people to miss opportunities because the best loan is the one that fits your unique situation, like your credit history, your cash on hand, your monthly debts, the property type, and your timeline to buy, and your future refinance or investment plans. When I work with clients, I keep it really simple and very transparent. I compare options side by side: rate, payment, cash to close, mortgage insurance, and break-even timelines for paying points or refinancing. My goal is to help you make decisions based on math and not pressure. And let's break down conventional loans a little bit more. These are some of the lending standards. Conventional loans follow strict conforming guidelines. So all lenders are going to have the base guidelines for Fannie Mae, Freddie Mac, and they reward clean files, good credit, stable income, and solid reserves if required. And here's how they typically work. Credit score. Most conventional lenders require at least a 620 credit score. The higher your credit score, the better your interest rate. And once you're at 740 or above, you'll usually and typically qualify for the best terms available on a home loan. A lower score typically means a higher rate due to risk. And a lower credit score is viewed by the lender as a high risk, so that means the rate is going to be higher. Debt to income ratio, also known as DTI for the acronym. Conventional guidelines typically cap your DTI around 50%. Depending on your overall credit profile, it may be lower. So if your credit history isn't as strong, then your max DTI may be lower. And down payment. Despite what people think, you don't need 20% down payment to get a conventional home loan. There are also some programs that allow as little as 3% down for qualified first-time home buyers. So putting more down can lower your payment and reduce or remove mortgage insurance sooner, but it's not mandatory to buy a house if you're a first-time home buyer with a 3% down. Who wins with a conventional home loan? So buyers with strong credit, verified income, long-term plans to stay in the home. These buyers often benefit the most because conventional mortgage insurance is not permanent. And let me give you a tip that many lenders don't mention. If you previously owned a home in the past, but you haven't owned a home in the last 3 years, so you sold your property over 3 years ago, then you're considered a first-time home buyer again, and conventional programs such as the 3% down will be available to you again. And here's another advantage. Conventional loans allow you to use gift funds, down payment assistance, or even seller credits, making them versatile for both first-time and move-up buyers. Plus, there are no upfront mortgage insurance premiums like FHA, and I'll get into that in a little bit. So your total long-term cost tends to be lower. And if you're looking for a comparison for conventional or FHA financing, don't hesitate to reach out to me via phone call or text. My phone number will be right here on the screen, so you can reach out to me, or you can go to my description and schedule a discovery call through my Calendly. And this way we can go over all the details and we'll get you exactly what you need. So let's explain FHA loans. We'll go a little more detail into that. FHA loans are backed by the Federal Housing Administration. That's why it's called FHA. They exist to make homeownership accessible to more people, especially those rebuilding credit or with limited savings for a down payment. And here's what you need to know. Credit score. FHA guidelines allow scores as low as 500, but most lenders set their own internal minimums called overlays. So make sure you speak to your lender and ask them if they have overlays. It's common for lenders to require at least a 580 credit. That's why working with a lender experienced in FHA home loans is going to maximize what you're able to get. And down payment. The minimum down payment for FHA is 3.5% down. And with credit between 500 and 579, you'll need at least 10% down. And debt to income ratio. FHA allows higher DTIs than conventional loans, 46.99 front end and 56.9 back end with an approved eligible loan. This flexibility can make all the difference if you have student loans, car payments, or other monthly obligations. And mortgage insurance. FHA loans require two types of mortgage insurance. You don't pay $2 a month, but there's two different types. So the first mortgage insurance on FHA is called upfront mortgage insurance premium, also known as UFMIP. It's 1.75% of the total loan amount, and it's usually and most of the time financed into the loan. So don't worry about paying that out of pocket. So the other mortgage insurance you pay on FHA loan is monthly mortgage insurance. So the monthly mortgage insurance payment stays on the loan for the life of the loan, unless you put at least 10% down. In that case, it falls off at 11 years. So if you put that 10% down, 11 years, you're not going to have the mortgage insurance anymore. The benefit, FHA can help you buy a home a lot sooner. Even if your credit isn't perfect yet, the trade-off is higher long-term costs unless you refinance later into another program. So who wins with FHA? Buyers with mid-level scores, those wanting flexible approvals, and those planning to refinance once equity and credit improve. And even people with perfect credit profiles opt for FHA in some cases as well, due to the lower down payment. And also, FHA isn't just for first-time homebuyers. And similar to conventional financing, FHA loans allow you to use gift funds, down payment assistance, or even seller credits, making it versatile for both first-time homebuyers and also move-up buyers. And here are a few types of FHA loans. The most common FHA loan is called a 203B. That's a standard FHA purchase loan most buyers use. But FHA also offers other powerful programs, other options like the 203K renovation loan. It lets you purchase a fixer-upper and finance repairs in the same loan. So you have the streamlined version. It covers smaller cosmetic updates, so you're able to get a little bit less money when it comes to the financing amount to do the work on the home. And the full version 203K loan covers major rehab work with contractor bids and draws. And also, after you own the home, FHA Streamline Refinance. Once you purchase a home with an FHA loan, the Streamline Refinance is available, which makes the process very simple when you're looking to reduce your mortgage interest rate and reduce your monthly mortgage payment. So the point, FHA gives buyers more ways to say yes. And if you love a home but it needs work, a 203K loan might make it possible to turn that house into your dream home in one step. And here's something most people overlook. FHA loans can also be used for multi-unit properties, up to 4 units, as long as you occupy one of the units. That means you can buy a duplex, triplex, or fourplex, live in one unit and rent out the others to build income and equity. So comparing FHA loans to conventional loans. So let's compare FHA and conventional side by side because both have unique advantages depending on the buyer. Approval flexibility. FHA wins. It's more forgiving for lower credit, higher debt to income ratio, and past credit hiccups. The long-term cost, conventional usually wins right here, with no upfront mortgage insurance fee and the ability to remove PMI a lot sooner. And conventional loans tend to cost less over time, especially for strong credit buyers. Monthly payment, surprisingly, FHA can sometimes deliver a lower monthly payment than conventional, even with the mortgage insurance, because it's lower base rates that FHA offers. At mid-tier credit levels, FHA often beats conventional by $100 to $200 per month. And cash to close, FHA's 3.5% minimum down payment is a huge win for buyers trying to conserve cash. Conventional loans can go as low as 3% to 5% depending on the conforming or high balance conforming loan amount, but credit score and PMI pricing can raise total costs. So future plan, if you're planning to refinance in 1 to 2 years, FHA can be a smart stepping stone. And if you plan to stay in the home long term, conventional can save you more overall. And here's a key insight. I felt many clients start with FHA because it got them into the home a lot sooner. Then, within 12 to 24 months, we refinance them into conventional loans once their credit improved and their equity increased, eliminating mortgage insurance and saving them hundreds of dollars per month. And if you're ready to take action right now and start your home buying journey, don't hesitate to reach out to me via text or call. My number is going to be right here on the screen. Or you can go to my description and schedule a discovery call through my link. It'll be my Calendly, and then I'll be more than happy to put something together for you and answer all your questions. And let's get into PMI removal tips. A lot of people don't talk about this. Private mortgage insurance, also known as PMI, doesn't have to be permanent on a conventional loan. Here are 3 common ways to remove it. Number 1, reach 78% loan to value, so LTV. Lenders are required by law to remove it automatically once you hit to 78% loan to value. Regular payments to the loan, or maybe you have a large lump sum payment to help you bring your loan balance down. And they're going to use your original home value, home appraisal to get to that 78%. Or number 2, reach 78% loan to value by doing considerable upgrades to the home, not just cosmetic. So speak to your loan servicer about this option. They're going to give you all the details. This can take some time, but if you did upgrades to your home and you order an appraisal and you go based off what the servicer asks you to do, you may be able to remove PMI based on the increase in value on the upgrades that you added to your home. So when you speak to the servicer, you have to ask them these questions. They're going to have specific things that you have to do. Or reach 80% loan to value through home appreciation over a period of time. Speak to a loan officer and refinance into a conventional loan that does not have PMI. And let me give you a pro tip. This may not need explanation, but it's really important to know. Keep your property clean and very well maintained before an appraisal. They're not going to appraise your value based on the cleanliness, but you want to make sure your property is showing well. And also document any improvements you made with receipts. Make sure you keep all your receipts and photos, and keep all the bids from the contractor as well. And also know your neighborhood comp so you time the request right. And you can speak to your loan officer that you're working with and they can give you information, or your local real estate agent as well. And here's a bonus insight. Some buyers use PMI strategically, putting less down to keep cash liquid for emergencies or an investment later on in the future. Then removing PMI once equity builds. It's about strategy and not just saving. So make sure you strategize with your loan officer. So let's go over the difference between appraisals for conventional and FHA loans. Every loan type cares about the property value, but FHA has additional standards for safety and livability. And here's how it works. Conventional loans require a standard appraisal to confirm market value. It's pretty straightforward the way they do the process. FHA loans require the same appraisal plus a basic safety inspection. So here's what the FHA check ensures. Utilities are working, that paint is not peeling on older homes or any home, handrails are installed where needed, and there are no major safety or structural issues. It's not extreme, but it's an extra box to check for FHA. Because of that, some sellers may hesitate when they hear an FHA offer, but these extra steps are actually really great for you as the buyer, because you'll know that you're buying a home that is safe and livable. And this is why communication matters in a real estate transaction. When I work with FHA buyers, my team makes sure that listing agent understands the strength of your file and the speed of our process. That clarity helps the offer stand out much more than others, even in competitive markets. And putting it all together, if you've been told no, FHA might be your yes. If you got strong credit and want the lowest long-term cost, conventional might be the better move for you. Either way, you deserve options in writing. You deserve to understand the why behind every single number on your home loan. And you deserve a game plan for today and a plan to make your next move. So what happens next? And here's how I work with you, or any loan officer will work with you. We'll collect your documents, so all of your income documents and all your asset documents, and we price FHA and conventional loans on the same day because rates change every single day. You want to make sure you make a solid comparison. We show your rate, your payment, cash to close side by side so you understand everything. and you choose with confidence. There's no guessing with this. And if you want me to run your numbers, I'll map both plans personally for you, and we'll see exactly which one fits your budget and your timeline, and build a plan to remove mortgage insurance or refinance when the time is right. And you can reach out to me by phone or text, or go to my description and schedule a discovery call with me. And that's how you win, with clarity, with a plan, and with a loan that matches your life. And remember, be smart, be prepared, and let's get you home.